In this presentation, we will discuss the objectives of the bank reconciliation process. Here we go with Xero. Here we are in our Get Great Guitars dashboard. We're going to start off by opening up our trial balance. So go on over to the accounting dropdown. We're going to go down to the trial balance. Once that opens up, we will be duplicating the tab by going up to the tab up top, right-clicking on that tab, and we will duplicate that tab. Going to change the dates in the drop down, this time to the month of January. So let's go up to the month of January. That's going to be the first month that we will be reconciling. We have done 2 months of data input. We're going to be thinking about the reconciliation process of January 1st and then February. We'll be reconciling here the checking account. Now, let's just first think about why you want to do the reconciliation process. What's the point of the reconciliation process? It's going to be a really important type of thing to have because really it's the second best internal control we have. In other words, the first internal control we have is basically the double entry accounting system. Assets equal liabilities plus equity. In other words, the debits equal the credits, as we can see here. The system basically forces us to do that. So the fact that we're using accounting software, good accounting software such as Xero, will pretty much mean that we are going to be in balance. And that's one of the first internal controls checks to make sure that we are doing things properly. The second best check that we can have is that reconciliation process. Now, when we do the reconciliation process, note we're checking more than just the bank statement here. We're not just trying to see that the cash is all right, which that's important, obviously, but we're also checking, in essence, many of the other cycles because cash is involved as we jump over here into our flowchart. This is in QuickBooks Desktop, just considering the flowchart over here. As we consider our flowchart, notice that cash is involved in the major cycles of every cycle. So unlike any other account, cash is involved in every cycle. So it doesn't mean that we can't still be wrong in the cycle somewhere if cash is wrong in some way. But if we can lock down cash, not only is the cash amount on our balance sheet correct, but it's also giving us some indication that our other accounting cycles are correct, at least with regards to that component. So note that with the vendor cycle, we of course have the accounts payable, non-cash transaction over here, and then the cash transaction over here when we make the payment. So over here, if we can reconcile this component, we're reconciling a major component, a major part of the vendor cycle, the AP cycle, or the purchases cycle, whatever you want to call it. Revenue cycle, same thing, or the customer cycle, or the AR, accounts receivable cycle, whatever you want to call it, same kind of thing. If we have the full cycle, we've got the invoice, non-cash transaction, and then, of course, we're going to receive and get the cash and eventually put it into the bank. We're considering when it actually goes into the checking account at this point in time. Crucial part of the revenue cycle as well. And obviously on the employee side of things, same kind of thing happens. We're going to see the cash going out of the checking account with regards to the payment cycle for the employees. We still have the withholdings and the payable that we'll have to deal with. That's kind of a non-cash transaction when we process the payroll. But obviously at some point in time we will then pay it, and so cash will be an integral part of that transaction as well. Now the typical full service process for bookkeeping would be that we're going to enter the transactions on our side as we have been doing here, right? We've been entering the transactions, including the cash transactions on our own, on our side of things. Then we're going to go and double check those cash transactions for the bank. And the cash transactions represents cash going out and cash coming back in. Any check or cash that's going out that we put into our system should be the same in the bank statement, right? We should be able to compare and contrast that to the bank statement and see the same thing on the bank side. It's just going to take a little while for it to clear the bank. The same with the deposits. Then we can double check our books to the bank's books, and by doing so, we have a double checking kind of factor. Now, I do want to point out that the more that you're dependent on bank feeds, like you could set up a cash-based system where you're basically completely dependent on the bank feeds. And that's okay. We'll talk more about that in the bank feeds type of section, but it's a little bit different when you consider, what's the effect of the bank reconciliation and how are you treating these bank transactions. For example, if you're on a completely cash basis and you're not recording anything into your system until the bank feeds show the receipt of money and the disbursement of money, then you're on a cash basis, not only on a cash basis, but basically dependent on the bank. So that means that you're not really reconciling two sides of the books. And again, there's nothing necessarily wrong with that. You just got to weigh the pros and cons of the two systems and see what's best for your type of company. But if in that case, it's going to be a bit different on the bank reconciliations because obviously your whole entire books were not created from you first entering the data and then checking to the bank, but strictly from the bank transactions. And therefore, when you do the bank reconciliation under that kind of system, you're really just checking to make sure that you didn't miss anything or duplicate or double up on the entry, because all your information came directly from the bank. So we're going to talk about a full service kind of system here where we have already entered the transactions on more of an accrual type of basis. Then we want to check and compare these transactions to the bank. When we get to the bank feeds, we'll discuss some other kind of options you might have where you might be more dependent on the banks and have a cash basis system and the pros and cons of that type of system. So if we have a bank statement, then would look something like this. And even if you have the bank feeds set up, you typically want to do the bank reconciliation from time to time, because that will allow you to get, well, from month to month, because that'll allow you to have a beginning balance and an ending balance. If you're just getting the bank feeds from the bank and you're like just printing a line of transactions out, you don't have that cutoff date. You don't have that line of, hey, here's the beginning balance. That's where we should be. That's where the bank is at that point in time. And here's the ending balance. Here's where we draw the line. That's where we are at that point in time. You need that kind of difference, that kind of line, that cutoff, in order to do the reconciliation process, because the reconciliation process will, in essence, tell us what the timing differences are. In other words, we're going to be looking at the bank reconciliation for the end of January. What we really want to see is say, hey, look, this is the amount that the bank says is on the books in our cash account for, the checking account for January 31st. And if we look at our books, it'll almost always not be the same as of that point in time. So in this case, if we went to our books over here, we're going to say, all right, the cash account according to our books has the 94,979.12 in it. And so there's a difference there, right? Now that difference, it could be, well, you might first think, well, there's a problem. Someone had a data input error. We probably didn't input something or something like that. That may well be the case. But even if we entered everything perfectly, there would still typically be a difference. Why? Because the bank statement is going to have a timing difference. The bank doesn't know about our transaction until it clears the bank. So what we would, under a full service bookkeeping system, typically we would do things like make the deposits and write the checks. And when we make the deposits and write the checks, we put them into our system. They're done. They're in our system. We know they're out there, and we put them into our system at that point in time. And then the bank's going to have to wait, especially on the checks, until someone gets the check, someone's got to sign the check, someone's got to deposit the check, and then the other bank's got to talk to our bank in order to know that the check has then been cleared. So there's going to be a lag between the point in time that we know about the transaction that happened when we made the transaction, and especially with checks, and when the transaction cleared the bank. That's going to be a timing difference. So that's what we're going to reconcile here. We're going to say, okay, the fact that this number is different than what we have may be due to, we're pretty sure it's probably due to timing differences and or errors. And if we can then fix everything so it's just the timing differences and then know exactly what those differences are, then we can reconcile our books to the bank and we could be confident that we have that reconciliation. Therefore, we could be confident that the books are correct with regards to the cash. That's how we're going to reconcile this. We're going to say, hey, look, if I can get this to tie out to my books and know exactly the difference being the number of checks that are outstanding and deposits that are outstanding, then I'm confident that this information is correct. We can then go back in and double check those outstanding checks to see if they cleared in February. And if they did, that's fine. It's just a timing difference. They cleared in February, and we have then reconciled our books. So then how do we do this? Basically, what we're going to do is we're just going to take all these transactions that are on the bank statement and we'll compare them to our books in the system. So we're just going to say, all right, here's the bank statement and here are our books. Now I'm going to go back to the first tab to do this. I'm going to go to the dashboard. Let's go to the dashboard on the first tab. And then I'm going to go down to our banking information, our checking account. Here's our checking account information. I'm going to select these three little dots in the upper right, the three little dots in the upper right. Then I'm going to go up to the account transactions. And this will basically list our account transactions here. Now note we have three tabs. We have the account transactions. We have the reconciliation tab on the first tab. And then we have the bank statement tab. And then we're going to be here in the account transactions tab. Now, if you have the bank feed set up, then as you have the bank feed set up, you can basically kind of reconcile as you go, because if you're tying something out from the bank feeds, then you can basically say, hey, yeah, that cleared the bank. We'll talk more about that when we get to the bank feeds. Here, we're going to do basically the manual reconciliation. So you can see what we could do then is go down and check off all these items in that have cleared the bank. So here's the 25,000. That's the beginning balance. Here's the beginning balance for us here. The beginning balance is one of the more tricky kind of components when you first start your first bank reconciliation. Then we're going to have the 65,000. We could say, okay, that cleared the bank. Here's the 65,000. So we should be able to tick and tie everything off and say that it has then cleared. The way we're going to do that is see if we have these unreconciled amounts on the right. So what we're going to do is we're going to go up top to this little question mark, and we're going to say that we want to, this little item down here, enable mark as reconciled. So we want to say we want to be enable mark as reconciled item. And then if we go down below, we can select transactions and we can mark them as reconciled. So we can change the status here from this unreconciled to reconciled. And we could do this by basically checking off the account, and we can go to the mark and we can mark as unreconciled. So I won't do it right now, but we'll do that later. And that's how we can tell the system, hey, look, these items are items that have cleared the bank. So then I'm going to right click on this tab again, and we're going to duplicate this tab. I'm going to go back to the first tab, and then we'll consider the bank reconciliation report. What's going to happen when with the bank reconciliation report? So you're imagining then we go through here, we make everything that we can find that cleared the bank, we mark it as reconciled. The things that will then be unmarked are going to be items that then are going to be part of the bank reconciliation. In other words, if we look at the bank statement here, we're going to go from the bank statement to the report. If it's on the bank statement and it's not on our report, it's probably that we made an error. In other words, we probably have to add something to our numbers. In other words, for example, these two items, the draws and the bank feeds, or the charges from the bank, items we probably don't have, I'm going to add those. If it's on the books, but it's not on our bank statement, it's probably an outstanding item. So if it's on the books and not on the bank statement, it's probably something that we entered as of the end of the month, possibly, that didn't yet clear and will be clearing in February, and therefore be outstanding in January. So anything that's not checked off in our books then, that's in January, we would assume to be outstanding. Now, what's the system going to do with that? Well, if we go back to our reports then, if I go to the accounting dropdown, and we go down to our reports, and then we go on down to the accounting reports, we want to take a look at the bank reconciliation summary report. I'm going to choose the account, that being the checking account, and we're going to say this is going to be for the end of January. So January, the end of January, and let's update this report. Now, this report isn't correct yet because we haven't done the reconciliation process, but you can see what it does here. It says, here's the balance as of our books, the $94,979.12. And if we go to the trial balance, then that's what we have here on our books. And then these are the outstanding payments and the outstanding receipts. They're all outstanding right now because we haven't checked them off as having been reconciled. So once we check off all the ones that have been reconciled, the only ones left as outstanding that we have entered in January will be the outstanding items. And those will be the reconciling items. So we're going to say, here's the beginning balance. Here's the only ones that are still outstanding that are on our books that aren't on the bank statement because they're outstanding. They haven't cleared. They're going to clear in February. And then the ending balance at that point in time should be the bank balance, which will be this balance here. So that's going to be our objective. We're going to mark all these items off as reconciled if they cleared the bank, leaving only those items that are not reconciled, allowing us to do this calculation of book balance and then taking into account the outstanding items to get us to the bank balance, therefore reconciling the book and bank balance. So that's going to be it for now. Let's get out of here.